With a market capitalization near $900 billion and annual sales approaching $54 billion, Tesla, which was once just an electric car startup, has grown into a force to be reckoned with in the automotive world. And after 10 straight quarters of healthy and growing profits, there's no longer a bankruptcy risk at all. That definitely calls for celebration amongst investors. Those who were patient when the company was just a startup now have a reason to smile. And with just 5 short years, Tesla could be a bigger car company than Ford Motor Company and General Motors combined. So how true is this? That's what we're going to talk about today. Stay tuned. Now, Tesla has grown to a point where it now controls 4% of the entire U.S. market for automobiles, and Morgan Stanley predicts that the company will conservatively retain at least a 3.5% market share through the end of this year, and probably more than that. With Tesla growing sales as fast as 63% year over year in January, Morgan Stanley believes Tesla could command a 10% market share by 2026 and grow to control 18% of the U.S. car market by 2030. Along the way, Morgan Stanley predicts that Tesla will surpass the combined revenue of both Ford and General Motors by 2027. Well, Morgan Stanley realizes this is a bold prediction. It acknowledges that most investors still struggle to accept the possibility that Tesla, which is still less than 20 years young, will ever outgrow Ford and General Motors, both of which have more than a century of growth under their belts. But as the banker sees things playing out, the bigger Tesla grows, the more market share it will be taking away from Ford and GM, and thus the more their market shares will shrink. As a result, the target Tesla is aiming to hit, which is more sales than Ford and GM combined, is actually a moving target. Specifically, it's moving closer every day as Ford and GM shrink in importance. In a car market that isn't growing all that much overall, this means Tesla is playing a zero-sum game against Ford and GM. And from the look of things, Tesla seems to be winning the game. So the big guns in the auto industry are certainly coming for Tesla's number one spot in the electric vehicles. And unlike Morgan Stanley, Bank of America auto analyst John Murphy believes that the other top automakers could succeed in the not-too-distant future. The bank expects Tesla's market share to drop from about 70% in EVs to about 20% in the next 3 years. And that's because Ford and General Motors are gaining the bulk of the market share, which the bank expects Tesla to lose. So what's the origin of the Bank of America's prediction? While Tesla recently capped off an impressive year of performance, signs have emerged that its market share is slipping as rivals pick up the pace on EVs. Tesla held 66.3% of EV registrations in the second quarter of 2021, which was lower than the 79.5% it held 1 year ago. GM-owned Chevrolet saw its share of EV registrations rise to 9.6% from 8.3% a year earlier. Ford, Nissan, and Audi also picked up market share in the EV industry, and there's vague news of Cybertruck with no concrete plans. It'll be the best fit for Tesla to come out with a Cybertruck in 2022 if they ever plan to do it, or else they'll lose that share to the Ford electric truck. This just shows how much pressure Tesla has been getting from its competitors. The pressure could continue this year if fresh commentary from Ford and GM are any indication. Now, Ford CEO Jim Farley said that the company has about 200,000 reservations for the F-150 Lightning, and Ford is converting those into orders where people have to physically order the vehicle, and almost very few of them are falling out. Farley added he would like to reach electric vehicle capacity of 600,000 units over the next 22 months. Meanwhile, General Motors struck an upbeat note on demand for its first electric pickup truck. GM CEO Mary Barra said during an earnings call that more than 110,000 Silverado EVs are reserved so far, including reservations for more than 240 fleet operators. And the numbers keep growing every day. So as you can see, it's not clear-cut for Tesla. There's going to be some serious competition from its rivals. Both Ford and GM are looking to outperform the EV giant, not to mention the top Chinese EV makers like NIO, which are also gunning for the top position as the dominant EV-making company. But then that doesn't mean that Tesla won't do well. Despite the coming rush of electric vehicles from Ford, General Motors, and Toyota, famed investor Cathie Wood is staying very bullish on Tesla, which is one of her longtime favorite companies. The CEO of ARK Invest said that her base case on Tesla is $3,000 a share because ARK Invest's estimate for Tesla's success has gone up. Wood explains that the main reason for that is their market share. Instead of going down from year-end 2017 to today, it has actually gone up fairly dramatically. Tesla remains a top holding in several of Wood's closely followed innovation-focused ETFs. The firm's flagship ARK Innovation ETF, for example, counts Tesla as its top holding at close to 10% of the ETF's holdings. Wood added that the new EVs from the more established automakers only validate Tesla's strategy. Cathie Wood's ARK Investment Management took advantage of Tesla's recent decline to buy more shares of the electric vehicle maker. These purchases represent ARK's first acquisition of Tesla stock since June of 2021. In November and December 2021, ARK sold Tesla stock to take profit, with Wood stressing that she still likes the stock. Wood has said recently that declines in tech stocks have created buying opportunities. She further told investors that the important thing to keep in mind is the long-term horizon that they invest in. Tesla's recent outstanding delivery numbers for 2021 threw a lot of people for a loop, particularly those with ties to Wall Street. Wall Street is getting more bullish about Tesla stock, but greater optimism among analysts hasn't been enough to lift the price, given fear of higher interest rates. But that doesn't mean that the company doesn't have what it takes to stay on top of its game. Tesla quarter results always beat estimates, and the same was the case in 2021, and it's delivered 936,000 cars in 2021, with an 87% increase in the auto sales year over year and 308,000 vehicles alone in the fourth quarter. There was a chip shortage affecting the productions and deliveries in 2021, but the company was still able to deliver better than expected results. There's no doubt in the fact that Tesla has handled the chip shortage more efficiently than its rivals, giving them excellent results for 2021. And as analysts reports, this issue will subside in 2022, giving Tesla yet another cushion to go aggressive in its production and deliveries, and we can witness the upgradation of guidance in every quarter's results and a positive Tesla forecast. And that's not the only positive thing to look forward to in 2022. The opening of the new gigafactories in Berlin and Austin in 2022 can provide a big boost to production. It'll increase the global presence of Tesla and increase its capacity to produce 2 million units annually from roughly 1 million units currently. Whether anybody likes it or not, China is a big market for Tesla and EV in general. And according to the estimates, China will represent 40% of deliveries for EV makers for 2022, contributing nearly $400 in its share price. If China's market is handled properly, it could be a big tailwind for Tesla. What this means is that there will be enough demand to meet Tesla's increased production, and definitely when the demand increases, there will be more sales and thus more revenue for Tesla. And it's just natural that, any other factors excluded, excellent earnings results means an increase in the stock share price. Maybe Tesla will end up hitting the $3,000 price level. We'll just have to wait and look forward to it. It's been an amazing session. Thank you so much for tuning in today. Remember to like, share, and subscribe. Stay safe, and we'll see you next time.